Hi everyone, my name is Jacob Pickett, and I'm a rising sophomore. In my group is Django Murphy and Colbey Alsop, and our topic is listed securities, in particular debt. Listed securities are useful to the market as, unlike equity securities, debt securities require the borrower to repay the principal borrowed, thus allow for a safer return over a longer period of time. Debt securities is a financial asset where one party lends money to another. For instance, on the government bond, investors lend money to the government, and in return, the investors get a fixed amount of interest payments called coupon payments till the bond has matured. In listed debt securities, there's a few aspects of debt securities. I will be discussing bonds, and in particular, treasury bonds and corporate bonds, and discussing whether or not it is a bubble. It is widely known that listed securities, such as bonds, are considered the safest investment. However, they run the risk of two major things: prepayment risk and interest rate risk. Interest rates share an inverse relationship with bonds. So when rates rise, bonds tend to fall and vice versa. Interest rate risk comes when rates change significantly from what the investor expected. If the interest rates decline significantly, the investor faces the possibility of prepayment. If interest rates rise, the investor will be stuck with an instrument yielding below market rates. The greater the time to maturity, the greater the interest rate risk an investor bears, because it is hard to predict the market developments farther out into the future. Prepayment risk is when the interest rates have dramatically fallen in the bond, and thus the company pays the bond owner back in full sooner. This is when the scale has tipped from low face value and high interest rates to low interest rate and high face value. This in turn leaves the investor with a less of a gain, and it was paid back sooner, thus with less interest, and is now forced to put their money in a lower interest rate market. Now it begs the question: is listed securities such as corporate bonds, municipal bonds, and treasury bonds prices an asset bubble, the effect of inflation, the result of a normally functioning market, the asset having come into its own, or some other explainable phenomenon? First, the increase in yields, if it occurs, is likely to occur over an extended period of time for bonds. It is most likely won't occur in short explosive moments such as the bursting of the dot-com bubble. Thus, a bubble won't be as obvious and the treasury bond will stay relatively true to its worth. According to data compiled by Osworth Demeradian at New York University's Stern School of Business, the 30-year-old bond has suffered a negative return in only 15 calendar years since 1928. In general, the losses were relatively limited. However, back then, the yields were higher in the past than they have been recently, so it took much more of a price decline to offset the yield in the past than it would today, meaning that it would have taken much more larger burst to put the bond in a negative state. Take a look at the past 10 years. It has only steadily increased, and there can only be miniature bubbles that popped if the price exceeds the value of the bond, but the value is never too far off from where it needs to be. Even when taking into consideration how bonds yields are inverted of the interest rates of the market. As a result, I do not think that there is a large bubble in the treasury market. Next is corporate bonds. With the low interest rates from the 2008 crisis means it is easier to borrow money. Influential companies are issuing IOUs, and most people classify these bonds as junk bonds. Some companies you would know are Kraft, Heinz, Macy's, and Ford's. Companies in the junk bond status live on red ink, meaning that they are in debt and constantly losing money. In the corporate world, there is 10.5 trillion in corporate debt. Then most are that are handed out from these companies are issuing these said bonds. These companies can issue stock for increased money or can issue bonds and can collect cheap debt. There are essentially two buckets that you can be labeled and thrown into: investments grade bonds, which is similar to a credit score, and they have a tendency to pay back bonds, and high yield bonds, which is a junk bond, which is a bad rating. The bond market is a much bigger than the stock market, so when the bubble pops or blows up, it has a devastating impact on the economy as a whole. It doesn't look bad on the forefront because the rates are so low to borrow money that when more companies change from investment grade bonds to high yield bonds, it can flip a switch and change the economy. These larger companies that fall from good to junk bonds are often called fallen angels. The feds have come out and said that they will buy up corporate bonds, and the action alone has given many people trust to buy these bonds, which saved the bubble from bursting. However, the question remains for how long, because year after year, many of these fallen angel companies' debt only continues to grow. If inflation occurs by pricing of goods increases or consumers spend more on a daily basis, it lowers the cost of the dollar, which in turn makes the debt of these companies a lot more expensive. However, I do think that there is a bubble in the corporate bond industry, or a prolonged bubble that the government only temporarily stopped, that will one day burst due to poorly mishandled companies that are buying up cheap debt and fail to swiftly pay it back. And here are my sources.